Awesome. So we are recording. I'm here with Robert Wright, the author of One Nation Under Debt, which is how I found your work. I was looking for answers related to how much money should exist and found your book and was absolutely engaged and reached out to you and really appreciate your willingness to talk. And so just want to dive in and maybe start with that initial question and see kind of what you think about the framing of that question and if it even makes sense to approach um, initial thinking on how much money should exist in that way.
Yeah, well, um, I think that we should leave it to the market, basically. And, we should have a commodity money. And so the amount of money that should exist is where the quantity supplied equals the quantity demanded, just like with, chewing gum. We don't fret over how much chewing gum there is. We know the incentives are such that, people will produce as much chewing gum as other people want and no more, right? um, so the same thing happens with money, and some of the microeconomics is a little different, but basically it's the same idea. So if you make something like gold, um, your money, you don't ever have to worry about there being too much money, so to speak, because we know that with any good, that when the quantity supplied is greater than the quantity demanded, there's a glut, right? And whenever there's a glut, then the price gets bid down towards the equilibrium. And if there was ever the quantity demanded was higher than the quantity supplied, that would be a shortage, and the value of money would get bid up to the equilibrium. Um, and some nice things about gold is that the demand for it is not as an investment, but the monetary demand for gold was very inelastic, and the supply of gold, in the long run, was right around unit elasticity. So um, we could just say gold is so many dollars, and everything would take care of itself. We wouldn't need a Fed, and we would have a hard budget constraint on all of the states, of course, but most importantly, the U.S. federal government would face a hard budget constraint, and that presumably would keep it from going too much into debt, because the possibility of a hard default would be there, right, where it actually doesn't have enough gold to make its payments, and that would keep the amount of debt down, and maybe even get us into a situation where, like, many of the U.S. states, we would develop a rainy day fund or a sovereign wealth fund. And whenever there was a problem, like a major war or a catastrophe or whatnot, instead of borrowing, we would first, run down the rainy day fund.
Yeah, I definitely want to talk about the notion of a national rainy day fund because that was one of the ideas right at the outset of your book that I thought was really interesting, and also the fact that it had been, I mean, the historical context that you provide in your book is illuminating. But I want to, for a second, go back to the notion of money supply and money demand, and um, for what you were describing, that was if we were to switch to a gold standard under a current the fiat money, the money supply, um, it wouldn't be as tied to any particular structure because we're not on a gold standard, right? So is it conceivable that we could have a uh, money demand go up significantly based on um, societal problem sets, while the money supply does not, there's a lag to the money supply reaching the necessary equilibrium, or how do you think about that?
Well, like I said, um, they're both quite inelastic. The supply curve in the short run is very inelastic, and demand for monetary gold is very inelastic. So when you have two inelastic curves like that, not much can happen, really. There could be big shifts in supply or demand, but because it's inelastic and bumping up against another inelastic curve, you won't see much you won't see much happening. Um, it's not going to be total stasis, but you don't have to worry about huge sort of movements. And then the fact that the long run um, supply curve for gold is, uh, there are different estimates of it. Some I've seen some as low as zero point 0.5, zero point 0.8 sometimes comes up. Um, but I think it's basically um, unit one, in other words, is the in the long run.
Hmm.
So, and that's because um, it keeps up with incomes, not in the short run, but we know it traditionally has done it in the long run. And now that we have access to space gold, technologically anyway, I don't see why that could last essentially forever. Um, Even if we somehow mined every single ounce of gold in the entire Earth, we could go to other places in the solar system to get it if need be. And of course, there are other goodies out there in the solar system too that are intertwined with the gold. So we wouldn't be wasting resources just to go get gold for monetary purposes, because we'd also be getting all the other good stuff that are in those asteroids and comets
Hmm.
and things of that nature. So I'm not even worried about 10,000 years in the future. um,
Well, yeah. So, this is again under the assumption of a gold standard, right? Where what's the
yeah. Under a gold standard, under a fiat system, then it's up to the incentives of the government. And the US government, because the US dollar is still the reserve currency, it has an incentive to run into debt because it can essentially monetize that debt at relatively low cost. Um, if the U.S. dollar were to ever not be a reserve currency, then we might have a proxy for gold, like other countries face, where they have to come up with so many dollars,
uh,
right? So they face a budget constraint, um, or they face the risk of currency crises, like that big one that happened in 1997 and 98.
is this Zimbabwe or
No. Well, Zimbabwe's that's a recurring problem. No, the South Korean won,
okay?
and a number of other East Asian currencies, especially, were hard hit. India as well with the rupee, and then of course soon after that was the Russian default.
Okay.
So that's because they were borrowing in dollars, so they had to command dollars in order to meet their debt service payments. The U.S. government, because its debt is denominated in dollars, and it also controls the supply of dollars,
Right.
um, it doesn't face that hard budget constraint, and that's what allows it to run these huge deficits, at least in the short to intermediate term. though eventually it's gonna catch up to us. Um, Usually the way these things go is there's a slow decline and then a big decline. And we're in the slow decline period. When the big decline might come is hard to say. It's hard to predict. It'll probably be linked to some sort of major event, like a war or a major natural catastrophe, or maybe another big financial crisis, and the government tries to bail out the banks and other components of the financial system again, and but just you know can't borrow the money anymore to do it, and so we could see a catastrophic collapse.
So, what's both the nature of the collapse and what is stopping us from being able to address it beforehand and prevent it?
Well, what's stopping us from addressing it before is this fact that we have the reserve currency still, right? So we can issue debt and in the same currency, dollars, and we can make those at will,
Right.
right? And for politicians, especially in a system like ours, that's just pretty irresistible.
Hmm.
Um, Milton Friedman in a famous little interview once said, "Don't pay attention to taxes. Pay attention to how much the government is spending." Right? Because not all of it comes from taxes.
Right.
Increasingly, it comes from borrowing, which is just putting taxes off down, you know, into moving them into the future, which politicians also love to do because that way they can, dole out goodies to their constituents now, and the constituents don't feel any pain
Right.
because the government just borrowed the money. But eventually, there will be considerable pain.
So the other kind of frame I want to ask you about is this modern monetary theory associated with this. From what I understand, the deficit spending is viewed differently under modern monetary theory, where the deficit spending is um, is like injecting capital into the economy, and then that would cause some growth in the economy and would somehow ultimately help us in the long run. Is that an accurate framing? And is there uh, is there any nugget in there that would help us with the preventing of the collapse?
No, I don't think there's any nuggets in there. I hesitate to endorse yours or any version of MMT because it seems to morph whenever you catch them on something. They say, "Oh no, you just don't understand. That's not what we're saying at all," and then they say something else.
Okay.
Yeah, it just doesn't make any sense. Uh, I mean, well, I should. Part of it makes sense. The part that I've already sort of talked about, which is the fact that we can't really hard default. The U.S. can't because it can always just print more dollars,
Mm-hmm.
and soft default create inflation. Um, what the MMTers often bring up is, well, yeah, if the government prints a bunch of money to um, prints a bunch of money to cover its debts, we can always tax that excess money out of the economy.
And so what does that solve to
So
tax it
so
out of the
so so
economy?
we've got a debt of $37 trillion, right? And
Right.
there's so many trillions of dollars in interest that we have to pay.
Uh-huh.
Yeah. Um, so we print the money to pay the interest. If that money causes inflation, the MMTers say, well, we can just tax that money out of existence once it's been once it's been used to pay, to service the national debt.
And the argument against that is that the inflation will have already
Well, well,
occurred,
you're
or
well, you're talking about creating economic growth,
you
but
know,
high taxes to soak up excess dollars that you created just to pay interest on the national debt is not investment. The high taxes are going to hurt growth.
right. Well,
Yeah.
so one of the things I'm curious about is if there could be a reset moment where maybe this kind of printing occurs, or maybe there's some other mechanism, or maybe it's a rainy day fund of some kind or an endowment, but there's some sort of massive injection, and then the inflation does occur as predicted or something, or it occurs to some extent, and then after that it levels off, and so we have a new normal where the inflation stops after the initial spike or comes down after the initial spike, and we just um,
You euthanize the
acknowledge
bond.
prices at a new level or something. Is there anything there where we'd be able to get out of the predicament that we're in, while not going into that tax dynamic that you described?
Um, well, we can euthanize the bondholders, like was partially done in the 1970s, where you just destroy the nominal value of the bonds. You pay them what you owe them, the $1,000 face value on the bond or whatever, but now $1,000 buys you, you know, dinner maybe, right? So you've destroyed the real value of the dollar in the process.
So that
That's what's meant by a soft default, right? You haven't actually reneged. You paid the $1,000 that you promised for the bond, but the $1,000 is now that doesn't have the purchasing power that it had previously.
so when you say it would euthanize the bond market, it would make everybody that's holding bonds, everybody that's holding that, uh, would be
Would be
uh,
hurt,
would be hurt because the value, the purchasing power of those bonds would not be as much as they thought they would be.
right?
But the everybody that's not holding the bonds, that is, feeling this weight of the debt, would they be better off or worse off? It would be worse off because of the inflation for
They,
the
they'd
time
be
being, and
they'd
then
be well, yeah, because everyone. I mean, even if you don't own a U.S. Treasury bond, you own dollars,
uh-huh.
right? So any nominal balance would you'd be hurt. So any cash, people hold cash, they'd be hurt. People with life insurance policies that are nominally denominated, they would be hurt as well. Those who wouldn't be hurt would be people who own real assets like gold and real estate, because their nominal value would go up along with inflation.
So is the
That's the short run. In the long run, of course, everyone would be hurt in the sense that the U.S. government's uh, credit would be ruined. But maybe that's what we need ultimately, is for its credit to be ruined, so it can't borrow anymore, and then it has to do something like create a rainy day fund to
yeah,
meet contingencies.
so I'm just thinking about the math of $37 trillion in debt, and if it's reasonable to think that we could pay it off or pay it down significantly in any
Oh
reasonable
yeah,
amount of time, and how
yeah,
we
we
how we
definitely.
would do that.
Well, just stop running deficits and allow the economy to grow, which could be due to increases in productivity leading to higher per capita GDP, or just the population getting bigger.
And what if the population declines, as you've cut? So you cut the deficit, and then the population declines. Does that just mean that we won't go into more debt? We'll just be struggling for longer, but we
Right.
won't have 45 trillion, by cutting the deficit. But if we go into a population decline, there's no guarantee that we'll be able to pay off the 37 trillion.
Yeah, I mean, it depends on how steep the population decline is, and I don't know of anyone talking about that for the U.S.
Hmm.
This is more of an issue for like Japan because it doesn't allow, inbound migration, and it's well below ZPG at this point, right? Um, so yeah, big problem for Japan, potentially a big problem for China too, even
Hmm.
because of their one child only policy. They're headed towards a demographic cliff. So, but yeah, I think even without, I mean, even if we enter another period where we greatly restrict immigration, there are populations within the United States that are still well above replacement rate.
Hmm.
How long that'll last, we don't know. But that's one reason why we should get a handle on this 20 years ago, like I was arguing in that book that
Right.
you mentioned,
Yeah.
and absolutely need to do something now. And for of course, the first step is to stop the thing from getting bigger.
Hmm. Well, so one of the questions I had around the inflation argument was you mentioned Milton Friedman, the quantity theory of money, which, correct me if I'm wrong, is stating that there will be a proportional increase in prices based on the amount of money supply increase. Is that accurate?
More or less, yeah.
Okay. So, in the case that you were describing of like the bonds, um, I mean that's not felt in markets around like consumer goods, is it? Or how would the CPI go up significantly if it's only the money supply increase is only used to uh so you say euphemize the bond market.
Well, the money supply going up, it's the money supply for the entire economy. So it would cause inflation.
But is that speculative or is it
No, no, not at all. That's
but so what are the mechanics of it connecting from the bond market to consumer goods? Like
Well,
how
the
do you
government pays it to the bondholders. The bondholders then go out and buy Big Macs and automobiles and whatever other things.
but they're not going to buy 37 trillion Big Macs and automobiles, right? So it's like the how do
Well,
you
no, no,
and
well,
it
I
wouldn't
mean,
be evenly
we're not talking
distributed.
about paying off the national debt with $37 trillion. We're talking about um, paying the interest on the national debt to service it, right? To pay off the national debt by printing $37 trillion would cause a huge increase in the price level.
But so if it's just the interest payments and those interest payments are going to bondholders, the quantity theory of money argument is that those bondholders will then be spending so much in the economy that all consumer goods, that everything that's baked into that basket of goods of the CPI across the board will go up by a proportional amount to how much
Right,
you injected into that bond market.
right.
I think that's the one of the pieces that doesn't make sense to me yet, that it would somehow there would at least be a lag, right? That it would be you put it into the bond market and then it takes a while to affect the CPI, or is there a
Yeah,
precedent
and
for
that's so Milton Friedman said that there are long and variable lags.
okay.
But one of the advances in that Sumner book that I recommended to you, The Money Illusion, is that Sumner thinks that Friedman was wrong about the lags, and it was just because he wasn't focused on the correct metric, which is the nominal GDP.
Mm.
Um, but yeah, in any event, at some point, the prices will. I mean, look at what happened with the Biden's well with the stimulus for COVID. Was it the CARES Act, and then the Biden infrastructure thing that was passed in 2022? That took a little while till we started to see um, the CPI and the PPI and all of that going up. It's not a very long lag. I mean, it's not like it's decades or years even. It was what, two quarters maybe?
Well, so that timing was also, well, I don't know about each one of those pieces of legislation, but for, let's say, the CARES Act, that was still during a time when there were, we were still recovering supply chains. We were still kind of recovering in
Oh,
general.
and
Uh,
the Fed reduced interest rates. So we had a fiscal stimulus and a monetary stimulus at the same time. And the two, of course, interacted with each other. And that was part of the reason why the economy overheated there for a while.
and the overheating you're talking about is inflation, right?
Is inflation, yeah.
But so the inflation can also be caused by other things other than the fiscal stimulus and the monetary stimulus, right?
Not really, no. There can be a one-time change in the price level. So this is where one of the many things that is frustrating about the tariff debate that's going on right now is people say that it will cause inflation. And inflation is when prices go up, 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 up. What a tariff will do is simply increase the price of a good by the amount of the tariff. If the tariff doesn't keep going up, then the price will stabilize. It doesn't
Well,
just
so
keep going up and up and up.
what's the difference between that argument and the fiscal stimulus argument? Like, wouldn't it just be a stair step fiscal stimulus as well?
Well, I mean, it partly depends on how it's done. The sort of scenario where you just pay off the entire national debt with made up dollars would just cause a really big jump up in the price level, but then it would stop as long as you didn't keep pumping more money into the economy.
But so then it is equivalent for like a monetary stimulus or a fiscal stimulus or a tariff that prices will go up. It's just that they won't keep going up. They'll just go up at the amount of whatever stimulus or tax or
Right.
tariff that
And
you've created.
generally the monetary keeps going. And so that's what generates inflation in the sense of sustained increases in the price level.
So it's that the money keeps being printed, not that it's printed once.
Right.
Okay.
So have you never seen one of those diagrams? What do they call it? The like the cobweb diagram,
Uh,
um, where there so that you have expansionary monetary policy, it shifts out the aggregate demand curve, um, which raises prices. But then there is a leftward shift in the short run aggregate supply curve, which brings output back to the old level at yet a higher price level.
hmm.
And then if the central bank keeps trying to juice up the economy with stimulus, you just see this ever rising price level, but right along the natural output curve, the long run output curve. So that's why when we talk about trying to drive economic growth, we're talking about improving institutions and productivity and education and lowering taxes and things like that, rather than just printing more money, because printing more money just makes the prices go up.
Um, so on just the notion of prices going up, isn't there also something that like the power of businesses and consumers to keep like the like I remember the one of my first classes in economics was about willingness to pay. Like if our willingness to pay, and then there's more substitutes, and then there's more competition in the market, so that helps drive prices down. Is that force just completely counteracted by the massiveness of a um, an injection of some kind, or
Um,
Like what as individuals can we do in this moment where we're trying to like have some influence? Like we work for businesses that set prices. We are willing to pay for certain things. We're not willing to pay for other things. So are
You
we
work
able
for
to,
Monopoly?
what's that?
You work for Monopoly?
No, no, but I mean,
Well, you
like,
said that set prices
well, like
in a
a small
competitive
business can
market,
set how
firms
much
are
they,
price takers.
yeah, but I mean, like a small business can set the price of a sandwich, right? Or the, you go to lunch and
Well, not really. Not if they're in a competitive market, they can't. They can take a stab at a price, but they're if they haven't gotten it close enough to the equilibrium price, they're going to end up with a glut or a shortage. If they set the price too low, then a bunch of people are going to come in and buy up all their sandwiches real fast. And if they set it too high, then sales will be slow, right? So there'll be constant pressure to drive for them to move their price towards the equilibrium price for that market.
but that's like the in a vacuum example, right? That's how the
No,
model.
no, that's in a competitive market. The opposite of a vacuum. That's where there's many firms competing for the consumer dollar.
Right, but there's also a lot of other factors other than price, right? There's location, there's proximity, there's experience, there's all these other things that impact
Well,
the
so yeah, so defining what the market is can be tricky because in a big city like New York City, it's not like all of New York City is one market. In
right.
fact, for some goods, apparently each block is a separate market, just because of the high cost, I guess, of crossing the street or entering into another neighborhood where you're not known or whatever. But that just means it's the same analysis. But what's on that block? Are there six sandwich shops on that block or only two? Um, and if there's only two, then each of the two shops will have more pricing power, where they might be able to move the price a little bit and not suffer a big decline in their quantity sold and their total revenue. But the more firms that are in that market, the more and more they're price takers, and they need to discover that equilibrium price. Like you know about the dollar slices in New York, right?
No, what's this?
Well, for decades until the Biden inflation, basically since the great inflation up to the Biden inflation. So what is that, like 30 years or so? The equilibrium price of a slice of pizza, they have like these extra big floppy kind of pieces. Cheese pizza, was $1.
Hmm.
You wouldn't go to a place and pay $1.25 because you know that three doors down there's going to be another pizza place that will sell you the same thing basically for $1.
So you could go to any pizza place over the past 30 years, you could go to any pizza place and get a slice of pizza for $1.
For $1 in Manhattan. Um, there's an article about it by a fellow named Pete Earle, Earle, because he was amazed that this was finally broken, and I guess it's now a $1.25 or a $1.50 is now the I haven't been to New York City and well since just before the pandemic. This would have been a post-pandemic change. So I don't know what it is now, but it was quite remarkable how powerful competition can be, because the price level, of course, was increasing over that whole period. But pizza producers were able to keep slashing costs, getting more productive, in order to keep that dollar price point for so for so very long.
Okay. So I want to go back to the conversation about the rainy day funds for a
Yeah.
minute and what that has looked like in the past, and particularly at the national level, because I was looking at our state level rainy day funds, and we have rainy day funds that are designed for economic downturn, natural disasters, these different types of setups based on what could occur. But I was in reading your book, I was thinking more about like you described the like a war as a good example of something to save for, because so often nations go into debt when they go to war. And so, yeah, I wonder if you could talk a little bit more about that and how we currently think about rainy day funds and how we could think about rainy day funds in the future.
Well, yeah, I mean, it doesn't, you don't have to earmark it for a specific cause, right? You could just earmark it for whenever there's a deficit. And one way that there might be a deficit is because of a recession,
Mm,
in which case it would be a counter cyclical funds, kind of like a Keynesian thing. Or it could be another time. There's usually deficits is during wartime
mm,
because taxes don't go up a whole lot, but expenditures do. Um, Natural catastrophe, uh, and what I have in mind is something bigger than we've experienced historically,
mm,
right? Something that would have a serious impact on GDP. Like a 10-0 in Southern California,
mm,
right? So with California falling off into the ocean sort of thing, or
mm.
that island in the Canaries that is supposed to be slipping into two.
Okay.
And if the whole one side of it slips into the Atlantic Ocean, it would create a tsunami that would wipe out the east coast of the United States. That's a big natural catastrophe. Or have you ever been to Yellowstone?
Yeah. Hmm.
Do you know what you were in?
Uh, was it an old asteroid impact
Nope,
site? What
nope.
was I forget the story.
It is a super volcano
Oh,
caldera.
that's right. Yeah.
Yeah, and it's due to go off. I mean, in geological terms. So I mean, we may be long since dead, and our children's children may be long since, or it could be happening right now, and we just haven't
Right.
heard yet, right? Something like it would be very very huge, and on the scale of a major war in terms of the destruction of human and physical capital,
Mm,
right? So yeah, right now that would basically collapse us
yeah.
because we are so far into debt. Um, as Alexander Hamilton or one of the founding fathers would say, we don't have any
Mm,
dry gunpowder, right? We don't have any reserves.
right.
And it's kind of silly, of course, to build up the reserves like Trump was talking about when he first came into office while we still have the national debt.
Right.
The first thing to do is to pay off the national debt. Then we can build a rainy day fund for any combination of these bad things happening. And then if they do happen, then we deploy the rainy day fund rather than uh, borrowing.
Yeah. Well, so would it make sense to create a rainy day fund for natural disasters? I mean, we know hurricanes are going to happen every year, and so it would just be less of a draw every year than like a super catastrophe that you're describing. So we create this gigantic rainy day fund, but we don't touch it unless there's a pandemic, a natural disaster, or I don't know, a supernatural. I don't know what the other examples would be, but um, the notion that we would stop using tax dollars for natural disasters and start using a rainy day fund, and then that rainy day fund helps us grow somehow and helps us with the debt as well. Or
They would be it would be tax funds. It would just be tax funds that have been invested, right? So tax funds plus whatever the accrual is um, from the assets that are purchased.
So but could there be a um maybe a middle ground where we don't print money to pay off debt, but we print money to put in a rainy day fund?
That's going to cause the same problems as printing money for any other purpose.
But the rainy day fund, it wouldn't go into the economy right away. It would only be,
Well, no, it does go into the economy because you're using it to purchase assets.
but only once the natural disaster has happened.
No, 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 no. You take it's just not a lump sum of cash. It is cash that is used to buy remunerative assets.
So are you describing quantitative easing when you're saying that, or?
No, no, no. I mean, uh, are you not familiar with sovereign wealth funds or the state rainy day funds? I mean, they're invested in securities, stocks,
So
bonds.
they're operating more as endowments where
Yes.
they're invested in something. But so could something exist as just a bucket where it's not invested in anything, it's just there for a, or actually, I mean, if it wasn't in, well, I guess it could go either way,
I
but
mean, if we're under a fiat system, why not just, then you're just talking about just create the money when you need it, right? We're back to that same difficulty. So, I mean, it doesn't make any sense to print up, 10 trillion dollars in Federal Reserve notes and have them sit someplace until some catastrophe occurs.
well, would it make sense if it were um sitting in state bank accounts rather than in the federal bank account? I understand what you're saying, where if you're just going to print it anyway, what's the difference? But I imagine there is
Well,
some
yeah, some
logistical
some
time.
some of the asset allocation could be as deposits in, not the Fed, but in private banks. Absolutely.
Or
Um,
in this, it could go straight to the state funds and then exist there until, like, we can predict to some level the number of hurricanes that happen every year, right? So we could say, we with some certainty will say this is how much money we think. So we're going to put this in all the state rainy day funds and then see if that's.
well, I mean, hurricanes is something that the government shouldn't be involved with, right? If we would just improve our insurance system, which could be done very easily by deregulating it, we don't need the government involved for hurricanes or like the wildfires in California. Um, all of the problems in those markets are caused by government regulations. So if they would just get rid of those regulations, we would see pricing based on actual risk, on actuarial risk. So that would mean that some people wouldn't build where they currently build because the insurance would be too high, right? Um, and some people would build cheaper than they currently build because the insurance would cost too much, but they want to live there, but they'd have to be self-insured, right? So you build very cheaply when you're self-insured, which is why, like in the Louisiana Bayou, you see all those shacks and everything. It's not because the people are poor necessarily. It's because why would you spend a bunch of money building something that could be easily, wiped out by a hurricane like that? So you build cheap. If it gets destroyed, you rebuild. Yeah. Or you build very, very solidly, which is more of the approach that you use in earthquake zones, right? You build something that can withstand, the normal 7, 8 magnitude earthquake sort of thing. It's the tail risk is where the government should be involved. When the really big thing happens, when we end up in a 10-year war with China, or when Yellowstone blows its top, or one of these other, truly catastrophic, widespread, that essentially no one has insured for. that's when government moving in would be appropriate. And that's going to be mostly just saving people, right? Not the rebuilding costs, just uh, not the rebuilding of private property costs, but
Right. Like
rebuilding
it's
all of the
response versus
infrastructure.
recovery.
Yeah, yeah, and rebuilding just a public infrastructure
Right.
system would be extremely expensive. So, yeah, not just your year to year sort of hurricane. Those
But
are
isn't that what hurricanes do though? They mess up public infrastructure, they destroy everything in their path and
yeah,
stuff.
but not that much. And if the insurance system is allowed to price risk, then uh, it can help people to rebuild from those hits. It's almost like having insurance for your annual physical at the doctor. It doesn't make any sense, right? You know that you're going to go get your annual physical. You know it's going to cost so many hundreds of dollars, so you save for that. It doesn't make sense to have any insurance for that. The thing with the hurricanes is it's not going to necessarily hit every year, but within every 10 years or 20 years, depending on your location, that one's going to hit. So you save for that by buying actuarially um, accurate insurance.
So, I mean, I get what you're saying with the houses, but the public infrastructure, I mean, there are towns built in places that and the roads and like the
Yeah,
my understanding of natural disasters is that usually the natural disaster overwhelms the region's resources to be able to both respond and recover. And so even if there was insurance, maybe that would help with individual homeowners and maybe some public
well,
buildings, but
why can't the government buy insurance?
doesn't the government buy insurance? Isn't
I
there
don't
insurance
think
on
so.
government
No,
buildings?
no, I think they self-insure all of that.
But isn't that what do you mean self-insure? Isn't it uh
I mean that the government doesn't buy insurance from Lloyd's of London or Swiss Re or something like that. If a catastrophe happens, then they borrow and they rebuild the whatever was destroyed, and they raise taxes, or they get subsidies from other parts of the state, or they try to get subsidies from the federal government. But it's not an actuarially sound approach, right? Because they're not making that annual premium, and they're not learning what risk mitigation techniques that they could use. That's the big problem out in California. They Nobody has an incentive to do risk mitigation because the insurance out there is so regulated, and the public is not paying for insurance for like public parks and public lands and whatnot. So they just see going out there and removing fuel sources as costs. So they don't do it. And then there's a whole bunch of dry wood out there when the fires get started, and of course, having all that dry wood just makes the fires worse, hotter, and spread farther and faster. But if there was an insurance company involved that could charge actuarially scientific premiums, they would go to property owners, they would go to the local governments and say, hey, you need to do XYZ or your premium's going to go up. Or if you do XYZ, we will lower your premium because you will have lowered the risk.
and so your thought is that if that was the case, the insurance companies would maybe not help with the response, but the recovery would be covered by them and
Yeah, just like it was in the 19th century. And the conflagrations would be not as bad.
The
Uh,
what?
the fires wouldn't be as bad, right? Our cities used to burn down in the 19th century, and they stopped because back then fire insurance companies could put premium pressure on businesses and individuals to engage in risk mitigation. Don't build out of wood, build out of brick.
Uh-huh.
You know, in businesses, you need to tell your employees about these contraptions on the wall where you can, pull the hose and spray the water or use the buckets, depending on the time and place. Um, and yeah, there was a whole architecture that was developed in order to stop fires. But in order to get people to adopt that architecture, the insurance companies had to step in and lower the premiums of the people who did the risk mitigation stuff. So
What wasn't some of this like the architecture that you're talking about, wasn't this also building codes and like regulation around adding fire retardant things and adding
no,
you have to be near a
I
certain
mean
fire
they did
hydrant?
that, but it was shoddy and behind what the insurance groups were doing. We see the same thing in automobiles today. The government does crash testing, but nobody pays attention to them. It's the insurance consortiums crash test that everyone pays attention to because they're much more sophisticated, much more realistic, um, and those are the ones that get followed.
Okay. Um, well, I think we covered a lot of ground.
We have.
I'm not sure. I think I definitely need to research more on rainy day funds and the potential there, particularly at the state level. But I'd love to have another conversation with you as I continue to dig deeper. And I appreciate your willingness to talk to me as uh, I kind of feel like I'm in catch-up mode. But anyway, I just want to say thank you.
Thank you. It was great talking to you, and would love to talk again.
Awesome. I'm gonna hit stop record here and we
Okay.
can uh